Good afternoon, everyone. My name is Denise Appleby, owner and CEO of Appleby Retirement Consulting, Inc. Thank you for taking the time to join us for this presentation today. Self-directed IRAs seems to be one of the areas in which many of my clients have interest. And interest was piqued. You remember in the 2008 general election, and there was much talk about Mr. Romney's IRAs and those large IRA balances, which I think it was determined that much of it came from investments in self-directed IRAs. So that, coupled with other things, has sort of piqued the interest in this area. Now, in many cases, the procedure that should be followed in order for an individual to invest in these type of investments seems simple enough, but then the technical area gets very complex. And usually I find that when I do get those complicated questions, I refer my clients either to an ERISA attorney or someone that specializes in this area. Fortunately for me, one of my clients is a small financial institution that specializes in this area, American IRA. The CEO of American IRA is Jim Hitt, and Jim was kind enough to do this presentation for you through my business for free. He's going to give you an overview of the rules that apply and answer any questions that you may have. There's a chat box to the right bottom side of your screen that you can use to submit any questions. There is also a handout of the presentation. We did a 2-per-slide screen and a 3-per-slide screen so that you can choose your preference. So if you haven't already downloaded your presentation, just click the plus sign that says handout and you can download your presentation from there. I am going to now hand it over to Jim. And if you have any questions, as I said before, please feel free to submit them using the chat screen. Jim, you're on.
Thank you, Denise. That was a nice introduction, and I appreciate the opportunity to speak to both you and your clients. It's a area that, as you probably would guess, we particularly like, the non-traditional assets. The goal today, Denise, is simply to get an overview presented to your clients about the process, and then of course we're here as a resource anytime anybody needs to get a hold of us. So with that mentioned, we'll move on forward. First, as always, we have to do a little disclaimer. The information is for general information purposes only and is not intended for tax or legal advice, and you may need additional material to answer some questions related to the topic. For legal and compliance reasons, we are unable to answer questions about specific cases. Please use the chat box on the lower left-hand side of the screen to submit your questions. American IRA is a company that was formed by myself in 2004, and we're a third-party administrator, and our specialty is non-traditional assets. We don't deal with securities, stocks, bonds, mutual funds in any form. We have thousands of clients, over 300 million in assets. As Denise mentioned, we're a smaller firm, but 300 million is a good start, I believe. We do have FDIC insurance on all the cash, so that is a question that your client will ask you, and our clients ask us on an ongoing basis, is how's the cash protected? The flexibility to invest in a wide range of investments, and we're going to get into that in a couple of minutes. A little background on myself. As I mentioned, I'm the CEO of American IRA, and I'm a certified IRA specialist. I've been investing using self-directed IRAs since 1982, over 40 years. And I've participated primarily because of the uniqueness of my background, it fits this particular business because about 70% of our clientele base has something to do with either real estate or real estate related products such as LLCs or mortgage loans, and 30% makes up a balance. But over 6,000 transactions myself personally, and I'm from Asheville, as is the company. We have an office in Charlotte. I'm past president of the Carolina Real Estate Investors Association, and I've been teaching in North and South Carolina at UNC Asheville, AB Tech, and Lorman Educational Services. So I've had a lot of fun sharing the word about self-directed IRAs over the last basically 11 years. When when our clients typically, let's say, well, what is a self-directed IRA? So they kind of fall in the category we say, well, I want to open a self-directed IRA, but there's many accounts that are in that particular area that we offer. And it's a traditional IRA, which I'm sure everybody's familiar with, the Roth, inherited IRA, a spousal IRA. These are a couple of that also can be self-directed, and many people overlook it, that they have an inherited IRA, or a non-working spouse can open an IRA, and may have one over the years, and that also can be used. There's a product that is a solo K designed for business people that do not have any employees that work more than 1,000 hours a year, and that's a phenomenal product. Has all the powers of a self-directed IRA in order to make investments, with a few nice features about, for example, very, very high contribution limits. When you can get that information on Denise's website quite readily. And you get the traditional 401k. The way that works is a small business plan that you may have for your employees can be designed to have a component that's allowed to invest in non-traditional assets, and we merely act as the record keeper and supply the annual valuations to the 401k administrator that would be existing. So that could be a very large source of additional investment capital that could be directed into non-traditional assets if one of your clients, expressed an interest in non-traditional assets such as real estate. SEP and Simple can also be invested into a non-traditional assets, and the Coverdell and the education account, health savings accounts, although not IRAs or retirement plans, are both tax advantaged vehicles, and they too can be invested in non-traditional assets such as real estate and gold and so forth. 529 plans are not something that we service. That's strictly a state product. Today we're going to be talking about the various investments that most likely are going to come up to you via your clients asking about it. So I circled the condos, townhouses, and single-family homes. Most of your clients are going to say, I heard I can buy a house inside my IRA and rent it out. That's the conversation is going to start. The other one is a friend of mine needs to borrow some money on a commercial property of theirs, and I would like to make that loan out of my IRA. I believe I can do that. That would be the second form of the conversation. And the third form of a conversation is LLCs and privately held companies. Somebody's going to come to you and they're going to say, I've got a friend of mine that needs some working capital for his widget business, and I want to make a loan to him, or I would like to invest in his business, and he's willing to sell me some shares of that business, either as a LLC or stock. Those are the three particular areas you're probably going to run into. And precious metals, is something that we do also, but I find that the first three, or the four circles, but there's three actual products. Two of them are very similar that you're going to run into as your questions. And then the question is, how do you deal with those? And then moving forward in this presentation, we're going to answer that to make your situation, when you're dealing with these folks that come in and say, I want to do this, that you know how to deal with it, and hopefully you give us an opportunity to work with you. But regardless of that, the procedures for these types of investments are not universal, but they're consistent across the industry. What circumstances will my client benefit from a self-directed IRA? I just went over that with the previous slide, and these are the four areas that you're most likely going to run into somebody that wants to invest, as I mentioned. Real estate, private entities, private stock, gold, or other precious metals seem to be the most common questions. I envision that as an advisor, that would be the folks you'd want to we would want to deal with in terms of their self-directed IRAs. Some investment restrictions, as you probably know, but it's worth repeating, is the Internal Revenue Service does not tell you what you can invest in. The Internal Revenue Service tells you what you cannot invest in. You cannot invest in alcohol, art, antiques, collectibles, some forms of metals. The ones that can be invested in are specific in the code. other, and believe it or not, other, one of the things is rugs. It actually mentions rugs, if you can believe that. So other than these investment restrictions, you can invest in stocks, bonds, mutual funds, real estate, approved gold and precious metals, private entities and so forth. That's how Romney got all that money into his Roth IRA, by investing in private offerings that Denise mentioned a little bit earlier. Now, when you're dealing with a self-directed IRA, there are disqualified people that you as the account holder will not be able to deal with. So the IRA owner is a person that cannot deal with their own particular assets, nor their grandparents, their parents, the IRA owner's spouse, children, spouses of the children, grandchildren, spouses, grandchildren. And here's something that trips people up many times. Entities the IRA owner and their lineal line owns or controls. So the question comes up all the time, well, my son has a construction business, can he do work on my property? No, he cannot. And we're going to address part of that as we move forward in this presentation. But just remember, entities the IRA owner owns and controls. Prohibited services. Now, attorneys, CPAs, and advisors, if they are providing paid services to an IRA or a 401k, they become disqualified persons to be able to deal with the IRA in terms of buying, selling, or transacting business whatsoever. So how that would it play out for this particular audience is, if you are an advisor to their IRA, you obviously are not going to be able to do business with them, and in most cases you're not going to want to, because it would be a very difficult situation for the fiduciary rules that you're under in most circumstances. Sweat equity, that's where your person wants to do the work themselves. That cannot be. You cannot add services or sweat equity to a piece of real estate, and you must have a contractor doing the work. And realtors, you may have realtor clients that you're advising. Many times they want to earn a commission by selling property to their retirement account, or conversely sell it when it's in their retirement account. They cannot do that. It has to be an arm's length transaction. They have to hire another realtor. And then also the same thing with a property manager. You must have a property manager to have a piece of real estate in your IRA. And the property manager, if they are your investor, because once again that could be a client, they can't do their own property management. They have to hire somebody else. Can't be for free. It can't be somebody else in their office if they're the broker. It must be a completely arm's length transaction. Now, I'm sure, based on some of the questions we received prior to the presentation, that everybody's heard of a prohibited transaction. And the consequences of it is that the IRA is treated as a distribution as of January 1st of the year in which the prohibited transaction occurs. So, for example, if something happened in October of 2014, then the IRA would have been distributed as of January 1st, 2014. So any profit that would have been made after January 1st, 2014 would have been considered as just regular taxable income. And if the person is under 59.5, they will have a 10% penalty, and they will also pay for a income tax if it's a prior to 59.5 and it's a Roth, and or whether it's a traditional IRA. Now, as you probably know, you don't pay taxes on the contribution portion of the Roth, but you would pay taxes and the 10% penalty on the profit. Now, it also it would lose bankruptcy protection. This is quite an area right now. Bankruptcy trustees are actually being taught how to, in quotes, pierce the IRA using the prohibited transaction questions. So that's something that would be unfortunate if a client were to be put in a position where they had a prohibited transaction. Now, I also want to mention that when we're talking about the IRA, if you have a $100,000 IRA and you do a $20,000 prohibited transaction, the entire IRA becomes distributed as of January 1st. If you have a 401k and you do the same $20,000 transaction, the only thing that is distributed is the $20,000. So it is a difference between the IRA and the 401k. So keep that in mind when you're thinking about using these particular products for your clients, or your clients are thinking about using it. A prohibited transaction by someone other than the IRA owner that participates in this, there's a 15% excise tax. So if it's a $100,000 account, there's $15,000 that they pay, plus a 100% tax if it's not corrected. So it can be quite costly if you get involved with a prohibited transaction and you're the person that causes it to happen. I put in the real estate process because I wanted everybody to understand how a piece of real estate gets into an IRA, because it's easy to sit there and say, oh yeah, you can put real estate in your IRA, but if you're not really in the business, you don't know how it gets there. So I hope you can appreciate the fact that we're walking through some of the basics, but the basics are going to be the ones that usually jump up and cause problems. All documents need to be in the name of the IRA, which is American IRA LLC FBO, the client's name, and the account type. For example, Roth. John Smith Roth IRA. If you're partnering with somebody, then the IRA is going to be American IRA LLC FBO John Smith IRA, and American IRA LLC FBO Jane Doe traditional IRA. So you can partner with a IRA with another person, just like you would be able yourself with general money. You know, if you pick somebody you want to partner with, you can partner with them just like you do your IRA. So that's not it's not a problem, just as long as the documents are listed in the name of the administrator, custodian. I want to also point out that all the documents, we're going to get into some of the process here, must be signed by the administrator, not the client. Believe it or not, the question we get all the time is, well, how do I get the money? How do I get the earnest money to the broker? The client fills out an investment direction letter. They send in the offer to purchase, and they read and approve it, and we send out the deposit money. It is just really that simple, and the money goes out very quickly to the real estate broker. The real estate transaction and the process and the documents required are good business documents. There's nothing in the Internal Revenue Service code that says you have to have all these documents. However, in order to properly have a piece of real estate in your IRA, there's some just good business things to do. The first thing for us that was needed is called a real estate investment letter. That letter tells us what to do, who the investment is being handled by, the real estate broker, attorney, price, contact information, copy of the contract that's read and approved. We're going to need a settlement statement. We're going to need a copy of the deed that shows that the property is properly vested in the name of the IRA, copy of title insurance, copy of hazard insurance, and wiring instructions. Those are the areas needed for the closing. In our particular case, as a company, we require these to close. It's not, like I say, an IRS requirement, but that's something that's just good business. It's a couple of helpful hints that we put in here for your reference later on. That the account holder cannot sign as the buyer. One of the biggest mistakes that a client will make that has a self-directed IRA is they will sign the contracts, and the contract is not void because it cannot be assigned to the IRA after it's signed. Then you have to void all the documents and redo everything from the beginning. So it needs to be signed by the IRA administrator as a custodian, and the client must read and approve all documents. We are not making decisions for the client, so the client must approve whatever they want us to do on behalf of their IRA. And all closings are required to be completed by attorneys, escrow companies, or title companies. No self-closings are allowed. The process by doing a self-closing is doesn't generally work out for the benefit of the client. And there's an example of a read and approved. Just at the bottom, they just sign their name, John Smith, read and approved, and we know to move forward. The other thing that we talked about earlier is about prohibited people. The IRA owner cannot use the property, nor can a disqualified person use the property, meaning this. Here's the most classic question we get. I'd like to buy a house at the beach in my IRA. I'm going to pay cash for it. And I'd like to have my son and my daughter be able to stay there, and I'd like to stay there, 14 days a year. Well, unfortunately, there are no available loopholes, in quotes, to be able to do that. You may not stay in the property, not even for one day, nor may you do maintenance on it that we just discussed in the previous slides. It has to be a completely arm's length transaction. Since the IRA owner of the property, all legal documents must be vested in the name of the IRA, American IRA, LLC, FBO. That's where we spend a majority of our time making sure all the documents are properly vested so they qualify to be in the IRA. And that in turn protects the client. And purchasing the property from the IRA owner or other disqualified persons is prohibited. The worst possible thing that a person can say is, I want to sell the property to my son or my daughter, or I bought a property from my son because my son has an entirely different name than I do, so it would have possibly slipped through the paperwork, but then it comes up at a later date. So you can't buy or sell from yourself or disqualified persons. Now, private entities is the other area that will be a very, very large portion of what people are going to want to do, that are going to come and talk to you about. If you read the financial magazines, investment news, the CPA magazines, it does not matter. Almost every magazine today has something about alternative assets. Now, in most cases, they're talking about alternative assets with Wall Street. However, in our realm of business, alternative assets means truly private entities that are not traded. And so when you're talking about a private asset or an alternative asset, that's something that's going to come up in an offering that somebody is going to be exposed to. And with a private entity, we have to have the documents, so we have it listed. Once again, if you notice the theme, everything is in the name of the IRA account administrator, account type, client's name. So if something does ever happen to an entity such as ours, the asset is always vested into the name of the client, whether it be real estate or not, or anything else. So in this case, it's, once again, John Smith likes to do lots of investments. American IRA, LLC, FBO, John Smith, Roth IRA. So the membership and the stockholder, we're going to list them on the appropriate documents in the entity. Now, the process for a private entity is there's a private entity investment letter, similar to the real estate investment letter, that tells what the investment is, who the parties are that we have to be in touch with. Private entity disclosure, and then we need the subscription agreement, we need the operating agreement, both signed, read, and approved. We need the signed and credited investor form, because many of these offerings are going to be for accredited investors only. Now, I mentioned earlier that we sign all documents. The accredited investor form, when required, is signed by the actual client. It is the only document that is not signed by the IRA custodian or administrator, because we cannot attest to their net worth, their income, but they can. And so until the closing documents have been signed, read, and approved, we will not close a transaction. It puts us in a situation where we would be not performing the duties that we've agreed to with the client. We do sign everything by electronic, so EchoSign for electronic signature, so it moves really quickly. And the documents if they're submitted by 10 o'clock, we can close in 48 hours without any problem whatsoever. and some additional helpful hints. The account holder cannot sign as the buyer. Many times what will happen is the promoter of the product, even though they have the authorization in their operating agreement to put retirement plans in, they're not necessarily knowledgeable of the how the IRA would work. So they'll ask the client to sign some of the documents. So it falls in the same category as we've discussed previously. The IRA custodian must sign as the buyer, and the client will approve it. Now there is a little thing that you may have heard about called unrelated debt finance income tax and unrelated business taxable income. Mostly people call this UBIT, unrelated business income tax. It's all lumped into the same thing, but it's not it's not correctly used. Real estate, private entities using debt financing to purchase real estate can result in unrelated debt financed income, meaning that a leveraged private offering, highly likely it would be up to a CPA to determine whether it is in fact a taxable event under the UDFI, but it's highly likely it's going to have some form of a unrelated debt financed income because it is a leveraged asset for a LLC. And private entities that are purchasing operating businesses will also result in taxable income, unrelated business taxable income, and you definitely have to have a CPA on these because they're going to have to prepare a form called a 990T, which we're going to talk about in a couple of minutes. Closely held stock, we've already gone through the processes, so I didn't want to repeat it here. But private stock falls in the same category as the LLC, except you're going to have the private entity investment letter, stock purchase agreement, and there are different documents from at different points in time from these stock offerings. So the certificate, it must be the name of the IRA, as we've talked about before, and an American IRA keeps all these documents for safekeeping in a fireproof safe. So the stock process and the LLC process and the limited partnership process are very similar in terms of their needs to move through the process. Debt financed investments, I'm going to go back to this. You can borrow money inside of an IRA or a 401k, as I mentioned in the previous slide. It must be a non-recourse loan, simply meaning that on a piece of real estate, that means that the lender can take the real estate, but the beneficial owner is not liable for it, nor is the IRA. Now, the debt may not be guaranteed by a disqualified person, meaning the IRA owner, their son, their daughter, their parents, or entities they own or control. And the debt within an LLC owned by an IRA may not transfer debt to the beneficial owner or disqualified person as members of the LLC, meaning personal liability. It's a long way of saying can't transfer the personal liability. And UDFI may occur with debt finance investments in an IRA. If you finance real estate in an IRA, it will be subject to unrelated debt financed income. With a 401k, that may not be true. There's a few exclusions in it, and generally speaking, if it's a 401k, there will not be any unrelated debt financed income if the loan is what's called a purchase money loan. Any kind of refinancing does incur unrelated debt financed income. If you have any questions about that, feel free to give my office a call. I'll be happy to talk to you about it. Now, unrelated business taxable income we talked about, and debt finance we talked about, unrelated debt financed income. So I wanted to go through and just give you a summary here of what we talked about in these previous slides, because this is an area that many people find to be challenging to understand. Why would a person do a transaction inside of a tax-deferred vehicle and end up paying taxes? So what is the benefit to the person that wants to finance a piece of real estate inside their IRA? Well, the benefit is very simple. Even though you're going to pay taxes outside of the IRA, you're going to have a taxable event after the few years when the depreciation is no longer available. There's a limit if you're passive and how much you can write off. And the other argument is, well, you lose capital gains treatment. Over here, you do have a subject inside the IRA. There's the unrelated debt financed income would in fact generate some form of tax on just the income, not on the capital gains portion. So what is overlooked in the conversation many times by CPAs, tax attorneys, and people debating the benefits of making investment inside your IRA is looking at what happens to the cash flow from the real estate over a period of years. There's no tax on it, and it grows tax-free. So if you do a comparison on the benefits of holding the real estate or the leveraged asset over a period of years and letting that profit on that real estate grow tax-free, then there's a argument, I believe, that makes it well worthwhile putting it inside of an IRA. But that's a decision that the client and their CPA and you as their advisor would have to make. But unrelated business taxable income is related to, as I mentioned before, LLCs as pass-throughs, limited partnerships, and those are, if you have an operating business, you're always going to have unrelated business taxable income, even in a 401k or an IRA. The unrelated debt finance, to recap here, is an absolute inside the IRA on a pass-through vehicle like an LLC, limited partnership. A 401k may, under some circumstances, not be subject to unrelated debt financed income. So that's why the 401k has so many great so many great tools that you can use to properly structure an IRA to save the unrelated debt financed income inside the 401k. Now a 990T, I mentioned that earlier, that is the form that the CPA will fill out to report unrelated business income and unrelated debt income. The report is a proxy tax liability. You can claim a refund from a real estate trust. That's the form that the accountant fills out. We don't fill this out whatsoever, but we do sign it when it's submitted to us, because the IRA is in fact the entity that pays for the unrelated business income tax. The tax must be paid out of the IRA or 401k if it's applicable. Non-recourse loans. I mentioned you can borrow money from an entity, but it must be non-recourse. We've described what that is. And it's secured by the real property only, and either the IRA owner or the IRA can be personally liable, and the bank can only seize the collateral. There is a little side note here. If the IRA is partnered up with somebody that is an individual or could be an LLC, and they have if they have a strong financial statement, they can personally guarantee the debt, but the IRA owner and the IRA cannot. So it creates non-recourse financing to the IRA, but as long as it's not a prohibited person or disqualified person that's signing the debt, then that too can be non-recourse. And leveraging within the IRA, we just talked about that, the benefits and the arguments to a small degree. Typically, the IRA owner needs to have a down payment equal to about 35% of the property's purchase price for most non-recourse lenders in this country. And keeping in mind, the one rule of real estate is keep some reserves, because you have to, as you well know, you can only put $5,500 away if you're 50 or under, and $65 if you're 50 or over, if you're over 50. So you need to have some money in there just in case there's any problems. If there is a problem, of course, the IRA can always borrow some money for refurbishment or expenses or whatever that they need. How is the IRA protected? This is a question that from dealing with our clients and dealing with professionals is always a question that comes up. How is the IRA protected? Well, first, everything that comes in cash is in an FDIC insured account. That's the beginning. We do not send out funds unless it's designed under a dual control system. There's no person that can send out money without a double signature. One person can originate, another person can approve, but the two people cannot do each other's jobs. Client must approve all wiring instructions twice before funds are released. We receive the wiring instructions from the client at the beginning most of the time, and they must reapprove it prior to funding. We will not fund without the second approval. That way we know the client still wants it to go there, have not changed their mind, and we don't take any instructions from the end user. We only take them from the client, which seems logical, but in our industry this has happened where people have taken instructions from the wrong entity, which is never good. And the company American IRA has the appropriate bond and theft insurance as a way of backing up the other procedures. I want to talk about an interested party designation. This designation allows the party, which I'm referring to as this listening audience most likely, identified by the IRA owner in writing to receive information about the IRA. This designation does not grant the interested party authority to buy, sell, or liquidate the assets in the IRA. It only gives them the authority to check on the IRA and have discussions with us. Otherwise, as you would guess, due to the Privacy Act, we can't discuss things with you without having this on file. Now, one thing that I've noticed over the years, and this is just a conversation because the audience that I'm speaking to right now is a high level, high performance, fiduciary type of audience, okay? So you want to take care of your clients, you want to do a good job, you want to remain involved, and that's what you're hired to do. Now, so you have the interested party designation. What I find is that the best business practice is to have us or the provider, whomever you choose, be in touch with the client to be able to gather their documents, make sure that they're following the checklists. Now, the reason I say this is because when a investment advisor is doing the calling for the client, what is happening is we're communicating to the advisor is communicating to the client. If for some reason the client misses something, then it goes to the advisor, then it comes to us, and we have to go back to you, and then you have to go back to the client. So that to the client's perspective, it looks like nobody knows what they're doing. Whereas if we do it ourselves, then and keep you, since you have a designated party designation, we can CC you on these emails and keep you in the loop. Then the client will be able to get first-hand knowledge of what is needed and what the process is. But I'm not saying you have to do that. I'm only telling you what I've experienced over the years. So you can decide how you want to do it. You stay absolutely in between it, or do a connection so that we're able to deal with them and deal with you at the same time. That's the one that works the best, but we work with advisors all the time, and each one has a different choice of how they want to do it. I'm just telling you the two different methods and what the good and the bad is. So you can decide from there. Annual administration functions. What we do is in January we issue a 1099-R for any kind of distributions, any prohibited transactions that are distributed or reported on this. In May we put out a 5498 which talks about what the balance is, and the Internal Revenue Service over, let's see, this year, I think it's this year, has, if you look at a 5498 now, has all kinds of boxes on there for real estate, private offerings, etc. on there that was not there just about a year ago. So the Internal Revenue Service has now become very aware that these assets are out there and they want an accounting for it. so they can keep track of these assets to make sure they're getting their tax money when the appropriate time comes. We do our annual statements that go out by the end of January, and account statements are available online at any time. And with the designated party designation, you should be able to access that for your client also. Now, annual valuations, I mentioned it previously. The way we do annual valuations is that we will accept for real estate a broker's opinion of value. We cannot use tax value. That has to be done annually. Then you have the LLC, LPs, and the stock valuations need to be completed by the manager of the company. The document I mentioned to you about the checklist for private offerings is, in fact, it states there when they sign it, the promoter of the product signs it, says they will provide this to us. Promissory notes can be valued at the current principal balance on a statement, secured or unsecured, and precious metals in each sub-accounts, like with Charles Schwab, Scott Trader, Fidelity, can be valued at market value. So that's how the valuations work from our perspective. The failure to provide annual valuations, so what is the penalty for that? As a custodian administrator, we have the right to resign and distribute the IRA. The reason it's so harsh is we're being put in a position where we're not able to provide to the Internal Revenue Service the required information. And as I mentioned previously, this information that was required is now very required because they want it broken down into individual boxes inside these 5498s. So it's not just a, well, it'd be nice if the custodian had the valuation anymore. It is now a very, very firm requirement, and has always been a requirement, but a very loosely followed up requirement by the Internal Revenue Service in our industry. They're not doing that anymore. So this is no longer just a something that we're sending out to, in quotes, aggravate our clients. This is a required situation. I'm emphasizing this because the clients sometimes don't think that there's a reason to have this, and obviously since you're communicating with them, it's important that you emphasize to them that this is not just something they can just ignore. Helpful hint or helpful tip is taxable distributions require a full appraisal in the assets. So for example, the beach house I discussed previously, they bought this in their traditional IRA or their Roth IRA, it does not matter. At the time of distribution, it has to be a full recent appraisal. Because if it's a traditional IRA, then there's going to be taxes based on the distribution of the asset. If it's a Roth IRA, there are going to be taxes on it, but they need to know what the accounting was at that time, because it's accumulated over a period of years, and they need to be able to track that. So either way, you're going to need a full appraisal. Now that also applies to any asset, whether it's a note, a private offering, it doesn't matter. So you have to have some form of an appraisal that is distributed. RMDs, one of the other questions that I get quite frequently is, some of our clients are older, not all. We have people that are from 30 to 80, it doesn't matter, as long as they have an interest in non-traditional assets. But RMDs, cash can be taken from any IRA, or it doesn't have to be from the, in quotes, the truly self-directed IRA where you can invest in alternative assets, or it can be done in an in-kind distribution. That's something that is many times overlooked. So that I gave there's an example here. A client has a mortgage note with a appraised value or a remaining balance of $100,000, and they need an RMD of $5,000. So the client can take 1/20th of the note as a distribution. Now the client will own 5%, and the IRA will own 90%, 95%, and over a period of years, the note will be distributed, and the monies will then be coming to the client. So it's a way to fulfill their obligation and remove the note from the IRA in a pro rata basis instead of paying taxes on it all at the same time. And this is, of course, reported on the IRS Form 1099-R, as I mentioned earlier. So keep that in mind. And we do have people taking distributions on real estate because they planned on it for years and years, and and they want that as income outside of the IRA. So it's not unusual for us. The big question, what does it cost for a company like ours to administrate an IRA? Well, we charge $50 to open up an account, and we charge $285 to hold the account open and to hold the assets, and that $285 is for unlimited assets, unlimited account value. So we don't charge if they make more money. We only charge our $285. We do not charge on cash-only accounts. So if a client moves money over there and they don't fund their investment for 3 or 4 or 5 months, there's not going to be a fee for that. We charge transaction fees for services as they are rendered. So for example, buying or selling of an asset, such as a piece of real estate, a private placement, making a mortgage loan, is going to cost $95. Any type of hard costs, wire, overnight, notary, FedEx, certified letters, those are reimbursed based on our fee schedule at the time. And that's pretty much our entire our fee structure. So next, what do we have coming up, folks? We have frequently asked questions, and I appreciate, and Denise appreciates, I know, you send in these questions because it makes it so much easier when you're doing a presentation like this that you have an idea of what people are expecting, so you can at least hit the frequently asked questions. So thanks so much for doing it. What if an IRA account holder provides services to the property owned by the IRA for no fee? Is this still a prohibited transaction? Yes. Any services provided by the IRA by a disqualified person are prohibited unless it, as to whether a fee or not is still collected. So you just can't do it. Is it okay for the IRA account holder to pay for things from their funds outside of the IRA, like insurance, like appraisals, like repair, like taxes for a piece of real estate? No, all expenses must be paid by the IRA, and that is just an absolute. Now, interestingly enough, there are ways, if the IRA does not have enough money, it's not used very often, but you can actually make a loan. Denise may go a different direction on this, but I've been speaking to some attorneys about this, and you can make loans to a plan in as long as it's paid back within 60 days. And then if not, then it has to be amortized over a period of time. So that's something we don't do very much of, nor do we let our clients really, we don't get into it a lot because we encourage the clients to retain funds in there, but it's a weapon in our tool belt in case we need to help a client out in terms of how to protect their IRA and if they need to pay expenses without creating a prohibited transaction. So I mentioned that to you so you know that there is something out there that can be utilized if a client is stuck. Is it okay for the family member to provide services to the account IRA holders as long as they don't charge a fee? No, any services provided by the IRA by a disqualified person are prohibited. One of the questions that came up, which was a logical question based on the audience, was whether or not an advisor could advise the account holder's IRA and not charge a fee. Unfortunately, that falls in the same category as property management that we discussed earlier, being a real estate broker. Your daughter as a real estate broker or your son as a real estate broker would not be able to sell a property held by your IRA and earn a commission. That would be a prohibited transaction. So it falls in the same category. And they also couldn't sell it even if they did not charge a commission. So unfortunately, the answer is going to be that it cannot be done. Are there problems if the IRA owner's son acts as an investment advisor, which we just talked about, if the investment advisor services aren't compensated directly? And the IRA owner's son is a disqualified person, and this would be a prohibited transaction. I covered it, I guess, a little prematurely in the previous slide. What is the reporting responsibility if the IRA owner commits a prohibited transaction? Do they just need to notify the custodian, or is there more? Notify the custodian is the first step. The IRA owner also needs to consult with their professionals to determine what steps are necessary to correct the prohibited transaction. If they, giving you an example of that, if a prohibited transaction occurs in 2015, which this is when this is being recorded, and it is corrected in 2015, that's the best case scenario. If it's after the tax filing, then it becomes more complex to be able to make a correction, and you definitely need a professional to deal with that. So that's all I'm going to be able to say on that as far as correcting prohibited transactions, but it definitely requires a tax professional that understands the IRA, 401k, businesses, and as Denise mentioned early on, an ERISA attorney is usually the most competent person to be able to help a person that is in a prohibited transaction situation. Some of the smaller things, may I fax or email documents? Absolutely. We actually, I mentioned earlier, we do sign by use electronic signature. There's a few documents that do need require originals, but there are only a few, and generally they come in at the very beginning of the opening of the account. Once again, can I pay utilities outside of my IRA? No, all expenses for the property need to be paid by the IRA funds. Am I able to pay the earnest money personally? No, all funds for the purchase must come from the IRA. Who will be signing? The custodian administrator signs all documents after they are initially read and approved. And believe it or not, that's one of the most difficult things that you're going to run into is the client signing documents that they're not supposed to. Where do recorded documents need to be held? All originals are held at our office in a fireproof safe. I want to thank everybody for spending their time with us today, and I hope that we've answered some of the questions. I'm sure there's more, but we have a great product. We call it a white paper, but it's actually a small booklet. American IRAs prepared a white paper, especially for professionals, and when I say is designed for professionals, registered investment advisors, CPAs, attorneys, etc. And it delves deeply into the dealings with self-directed IRAs and provides professionals with the information they need to better serve their clients. And you can go to our website and do americanira.com/white paper, and you can get a free copy. It's mailed out, so you'll have it as a reference. And we can also email one too if you requested it. But we send it out in hard copy, so we'll need your mailing address. And just so you know, the quality of this particular product is it was actually prepared by Denise. So I want to give Denise full credit for this. It's a great product, and we took we put a overview of a more simple approach with references to the code sections in the white paper, so it's an easy read to get to what you're looking for, just so you know. So it's not this is not what I would call a superfluous offer to get your contact information. This has got a lot of great stuff in it, and it's prepared by a person who knew their business very, very well, and that would be Denise. Thank you, Denise. AmericanIRA.com/white paper. I want to thank you for attending the presentation, and if you have any questions, you can reach us at AmericanIRA.com or info@AmericanIRA.com, and our phone number is 828-257-4949, and our toll-free number is 1-866-7500-IRA, which is 866-7500-472. And do we have any questions, Denise, that people
Yes, I actually do have.
Or did I put him to sleep?
No, this was very good. Thank you, Jim. You know, as I said, we do get a lot of questions in this area, and I think it is a highly specialized area that either requires the assistance of an ERISA attorney or someone like you or both. And there is actually a question here from one of the audience members. If my client wants to invest in a self-directed IRA and they want to know if it will result in a prohibited transaction, is that a question we can ask American IRA?
That's a good question, and thank you for asking that. The way that our business is structured, if you read our documents, we're not responsible for prohibited transactions. However, as Denise mentioned, you need somebody that does have a good feel for this, which is us, or an ERISA attorney. Now, starting off with us is a little bit cheaper to at least get the overview of it. So a conversation of whether something appears to be prohibited is easy to have with us. Now, ultimately, what I tell our clients and even professionals that call us is we cannot put the blessing on a transaction, say it's absolutely not prohibited. You know, something simple like son buying house, that's prohibited. But if you get into an extremely complex situation, we're going to listen to it and be able to get you in the right direction. But if it's a situation where you need additional advice, then you're going to need to go to Denise, or you're going to need to go to that ERISA attorney. But my summary on this question is we're a great resource for that type of conversation, as long as you understand that it is conversation and we cannot, in quotes, bless the transaction like an attorney could. Does that answer the question?
I think it does, and I agree that working with an ERISA attorney is highly recommended. The same person had a follow-up question. Is there an ERISA attorney that you would recommend?
Actually, you have a phenomenal resource with that's on the call with us right now, which is Denise, and she does have some ERISA attorneys that she's actually referred to me, so I'm sure Denise will be willing to share that, right?
Oh, I would be happy to, absolutely.
Okay.
We have no more questions.
Thanks for starting off with me, and I hope you got what you're looking for out of this. I appreciate it very much, and feel free to give us a call. It's never a bad situation to use this for a resource. If it's not something you need right away, maybe you'll need it downstream, and we're going to be there for you. Once again, thanks very much for listening.
Thank you, Jim.
Denise,
I
thanks
think
for
you
the
were just
invitation.
very thorough. Yeah, I think you were very thorough, which is why they have no additional questions. I really,
That's kind.
I really appreciate it. I really appreciate you taking the time to do this, and like you, I do hope they got something from it. Thanks, everyone. Really appreciate you taking the time, and I look forward to having you join us for our next presentation. Enjoy the rest of your day. Thank you.